Hi, my name is Metzner, and I'm a private wealth planning attorney at Jones & Keller here in Denver, Colorado. There's been a lot of talk since September about the Build Back Better Act, which includes some major tax increases. Fortunately, according to Senator Manchin, this act is dead, and I think that is most likely the case. But as is the case with most things involving Congress, we shall see. Regardless of the fate of the act, the contents of the act are telling as to areas in which Congress is likely to act with respect to taxes that are commonly referred to as death taxes. As with most hot topics, there is a lot of confusion as to death taxes. So today, I would like to provide some clarity on death taxes, what we know, what we don't know, and how we can plan for the uncertainties. First off, what are death taxes? Well, let's start with the technical term. Death taxes are a form of transfer tax that is formally known as the estate tax. Everyone is familiar with income taxes. If you receive a salary, that salary is subject to the ordinary income tax. If you sell appreciated property, the gain is subject to capital gains tax. Ordinary income tax and the capital gains tax are both types of income taxes, or the tax on receiving money in exchange for something. Transfer taxes, such as death taxes, on the other hand, are taxes at a rate of 40% on the right to transfer something without receiving anything in exchange. When would you ever transfer something without receiving anything in exchange? Well, in two circumstances. First, if you make a gift to someone. Second, after you die and someone receives an inheritance from your estate, they're receiving something you transferred without exchange for anything. There are three types of transfer taxes. First, the gift tax, which applies to gifts you make during your lifetime. Second, the estate tax, which imposes a tax on your gross estate prior to any bequests that are made. Third, the generation skipping transfer tax, which applies to gifts or bequests that are received by a person who is more than one generation removed from you. For example, a gift you make to a grandchild. This discussion is only going to focus on the gift tax and the estate tax. Now, Congress does not tax every gift we make, nor does it tax every estate. Rather, Congress has decided to set a dollar cap for gifts a person can make during life or bequests they can make after death before the transfer taxes will apply. This dollar cap is often referred to as the exemption amount. And under current law, each individual has an exemption amount of approximately $12 million. Married couples together have a combined exemption amount of approximately $24 million. So what does this mean? Well, let's use a hypothetical. Assume we have a single individual whose net worth is $20 million. That individual can either gift during their lifetime or leave as an inheritance at their death the sum total of $20 million before the transfer tax will apply. If the individual does not make any taxable gifts during their lifetime, then at death, that individual could pass $12 million transfer tax free. Now remember, we have an individual with $20 million, past $12 million transfer tax free. The remainder of the individual's estate, the $8 million, would be taxed at 40%. So $3.2 million would be paid to the IRS, and the remaining $4.8 million would be available for the individual's beneficiaries. Now, what if that individual had made taxable gifts of $10 million during their lifetime? Remember, the net worth is $20 million. By gifting $10 million during lifetime, the individual used $10 million of their $12 million exemption, so $2 million of the exemption remains, and the individual's net worth is now $10 million. Assume the individual dies with $10 million and $2 million exemption remaining. The $2 million passes to the beneficiaries free of estate tax. The remaining $8 million, again, gets taxed at 40%, so $3.2 million would be paid to the IRS, and the remaining $4.8 million would be available for the individual's beneficiaries. Great, Dylan. Thanks for explaining this system to me. So I can give up to $12 million away free of transfer tax, either during my life or after my death. What is there to plan for? Well, we can never predict the future of tax law, but we do have one certainty that is approaching on January 1, 2026. And that is that the $12,024,000 for married couples exemption is going to be cut in half unless Congress acts to keep the exemption at its current amount. And while not a certainty, the Democrats have made it clear that they would like to try to reduce the exemption amount sooner. If the Build Back Better Act passed, the exemption would have already been reduced. Therefore, one thing to plan for is the possible decrease of the exemption amount. There are many strategies, which have all been approved by courts and the IRS, to take advantage of the current exemption amounts. First, the IRS has confirmed that people who make gifts prior to a decrease in the exemption will not be adversely affected when the exclusion amount is cut in half. As an example, an individual can give $12 million today, and if the exemption amount reverts back to roughly $6 million, they would have sheltered an additional $6 million from the transfer tax. So one strategy for those who can afford to do so is to fully utilize your exemption amount before this amount gets reduced. Second, when a gift is made, the amount of the exemption used is the value of the gift the day it was made. For example, if someone gives an asset that may appreciate in value, and that asset is currently worth $12 million today, essentially the appreciation is removed from the estate of the person who made the gift. This creates a wonderful opportunity for business owners who are seeking to remove appreciation from their estate and leave more money to their family as opposed to the IRS. Now, this is just scratching the surface of a large iceberg. Individuals with a net worth of $6 million or more should review your current situation with an attorney who is experienced in transfer tax matters. If you wait until 2025, or if Congress acts prior to that time, you may be too late.